Hello guys, you are welcomed again to our new episode, a continuation of an episode called Volatility 75 Index. It was a live trade, and I just want to show you what transpired thereafter, and just also explain further on how these things do happen on a day-to-day basis. It's a continuation video, so you'll have to go back and start from the episode 1 so that you can understand what's going on here. So this Volatility 75 minute 1 time frame, and I just want to show you how our kill zones are effective enough, and that's where we do hunt for setups in each and every session. The day has got only 4 quarters, and those are 4 sessions. So the last session is where this 20, this is the opening price of our last quarter kill zone. So the day is collapsing, the day is ending, and you have to be very nimble on how you approach prices when the day is about to end or when it's about to start. The most probable time is when the day it's at 50 at equilibrium, when the day is at that is London and New York session. Those are good sessions to trade, but it doesn't mean that you can't find setups on other sessions. As long as you understand how to read market structure and institutional order flow, you can navigate through all the 4 quarters. But now it becomes tiresome. You have to choose one that you'll be working with, or 2 if you go at most. So let us analyze these charts, and I want to analyze these 3 trades over here. This one was a trade I took, and as you can see, after buy side liquidity being taken, we displaced lower to our minute 15 fair value gap. So after reaching our minute 50 fair value gap, after reaching our minute 15 fair value gap, we displaced higher, formed a fair value gap, and pumped higher, breaking the market structure. This is what market structure shift looks like. The prices are from a discount array called the minute 15 fair value gap, and has displaced higher, taking out the market structure. So these are breaking market structure, and any retracement below the 50% after the swing high that will have been formed before the down movement, we buy them. We buy the 50%. We buy the below 50%. So as you can see, this on a minute 1 chart, and as you can see, this is an order block. This is an order block here. I hope you can see it on your far left corner of the chart. The last up close candles before the down movement, that's called an order block. So this is a bearish order block. This one, it's a bearish order block. The last 3 up close candles before the down movement, and it must have taken sell side liquidity or buy side liquidity to qualify to be an order block. As you can see, it has taken buy side, now it qualifies to be an order block. And as you can see, the reaction just before our kill zone open, we engineered liquidity. Let me now show you how this thing is done. We engineered liquidity, displaced lower, our our kill zone opened and ran buy side liquidity. This is like a stop raid. This is to bring more buyers into the marketplace so that we can crash them. You must remember the order block to have this logic in mind. Without you knowing that there is an order block here, you will never see something like this in your charts. So there was a displacement, and the displacement caused a market structure shift. If you go down to a 15 seconds chart, you will see this thing clearly. But now that we have got no provisions of that on this platform, we will go by the 1 minute time frame. So you become very nimble, because in your mind you know we are bullish. We are below the daily open, the day is ending, and the market structure that's presenting itself is just telling you a story. And you can just see how the story is beautiful since we started. So the displacement happened when the kill zones raided the buy sides, the buy stops. After the displacement, the swing high that will be created immediately, you draw your Fibonacci retracement tool as shown below, and any retracement above 50%, you sell them. You sell those retracements. So as you see, we sold here we sold 0.5. I hope you can see we sold 0.005, volatility 75, and there is the trade. Our targets were 161.8 and 261.8, and as you can see, the partials were taken at 261.8, and we closed the trade fully at 261.8. As I told you, we were bullish. We were expecting bigger prices, and on my previous video, you can see I had a buy limit order placed just beneath the 50% on 261.8, but I removed it so that I can explain this video later. My time was up on the other video, that's why I removed the buy limits. As you can see, the range, our dealing range now is the range that created the market structure shift. You can evidently see the range that created the market structure shift. You measure using your Fibonacci retracement from 0 to 100 to measure your projections to the upwards. So what happened here is that after mitigating the order block, we displaced, then we sold the market, placed our stop loss. The stop loss, you place it by measuring your Fibonacci retracement, the 25% of 0 to 25 of our initial displacement lower that resulted to the fair value gap. That's how you place your stop loss. So, and as you can see, after we got out of our trade, they ran out sell side liquidity, and that was now below the 50% of the minute 15 fair value gap. That's called a consequent encroachment. We took out sell side liquidity, and as you can see, the price action around here is just beautiful, very beautiful, and you cannot deny the fact that it looks beautiful as fuck. So we reacted exactly at the 50% of the consequent encroachment, taking out liquidity, and you can see the bold candlesticks. People buying this kind of moves is very difficult, and as you can see, the sellers looks like they are very, very aggressive, and you can just change your mind. We led buy side liquidity by creating a swing high, took it out, creating a liquidity void. You can see this is the liquidity zone, the liquidity void. Sorry. So we displaced higher, and I bought, confidently bought, because we are below 50%, and we have taken out sell side liquidity. We have reacted from the 50% of the consequent encroachment, engineered a swing high, broke it, then caused a liquidity void. The liquidity void, as you can see, resulted to another displacement higher, causing a fair value gap. Just after our second hour of our kill zone opened, we found a displacement lower, mitigating the fair value gap. And remember, we are trading the 4-hour expansion candlestick. We are trading the expansion of the 4-hour candlestick. That's what you must be with it. That's everything I'm telling you here. This model is about trading a 4-hour candlestick expansion, and if the market structure is showing you a long-term investment, you take the risks, you don't avoid them, because this model is now happening on a minute 1 time frame, and there are times the model do happen on even our 4 time frames. The same thing you are seeing here, one day you will see it on our 4 time frame. The same way it's looking here, you will see it. So on our 4 time frame, this is also the entry criteria and the exit criteria. Nothing changes. It's universal, that is. So after 21, after we opened, we mitigated the fair value gap. This was a market structure shift to the upwards. So after mitigating the fair value gap, we moved higher, and our targets are as follows. The 161.8, basing on the smaller range here, but we have to bank on the bigger range now, from here to here, our bigger market structure shift. That's our dealing range. So your projections are supposed to align with the bigger market structure shift. So let us just see it. As you can see, let's go to our 2 minutes time frame. This is a 2 minutes time frame, and as you can see, the model is from 0 to 100, our bigger market structure shift that was resisted by the order block. As you can see, our first partials were to be paid at 161.8, and as you can see, the 161.8 was hit successfully, and we found a reversal. Then there was buy side liquidity above here, the one I had marked, and now there is this point 423.6, basing on this smaller measurement of hours. This was another partial we could have taken. So let's continue. These things, they might look fancy on your charts, they might look intimidating, fascinating, attracting, boring. Those are just some of the things that thing is looking like. And learning this thing requires a lot of determination, requires a lot of focus, requires a lot of motivation. And you might also say, why should I learn this thing and I don't have money to invest? Why should I learn this thing and yet I don't know if it's true? How can I learn this thing and yet I don't have access to the internet? Many excuses. How can I learn this thing when I can't buy data? How can I learn this thing if I don't have a phone? Those are some of the things that are what we call excuses. Those are excuses. You can't make excuses and expect that you'll make money in the long run. You have to have a burning desire that is making you to learn this skill, because it's a highly technical skill and a high paying skill that you'll ever learn in your life, that you'll ever meet in your life. You'll never encounter anything hard than the thing I'm trying to show you here. It might now look simpler, but when you start engaging yourself in the markets with real money, you will learn a lot about yourself, and you'll just wonder how the world is a beautiful place. You know, having no money should not be an excuse to not learn these things. And you also have to just choose to be rich. Just be rich before you start learning this thing. Because a rich mind, so you have to feed your mind with good things, beautiful sceneries, and everything around you should be rich. That's how you become rich when you have no money. And make that choice daily. You know, people sometimes see the price tag on top of my videos and they wonder what they are for, because I'm already teaching. You know, this thing is very difficult, and the journey is very tough. So you'll have to invest first in education. You'll have to learn. In reality, the only asset you have is your mind. The most powerful tool we have, that's the most powerful tool we have, your mind. And we have dominion over it. We have the power to feed it with successful things. And we also have the power to feed it with excuses and feed it with bad choices and everything. So most people simply buy investments rather than first investing in learning about investing. That's how you find people selling setups. And there are some fools who buy them, who buy the setups so that they can become rich. You must be having two ways. One way or the other. As you can see on our chart here, we had to analyze a problem. We analyzed a trend. Then we had two thoughts. We are bullish, yes, but this is our kill zone open. We have read buy side liquidity, and there is sell side liquidity racing here, and there are many discount arrays that are below the 50% of our dealing range after breaking the market social shift. So we have two options. We either wait and see how we will react, then we buy, or we sell and buy again, or we just sell and don't buy, or do all of them. And to do all of these trades here requires a lot of focus. It requires you to have patience, and it requires you to have a successful mind. The only way you will be able to learn from what I'm teaching you here is to be humble enough to listen what I'm trying to feed your mind. Being arrogant or critical just shows how low your self-esteem is. And as a result, you become afraid of taking this kind of risks because you fear to lose. Fear is the greatest potential damage of success. I'm saying this because after learning something new, you are required, or rather, it is normal to make mistakes in order to fully understand what you have learned. And it's just a beautiful chart before you, and the logic is also clear, nothing hidden. You can take notes, or you can also just download the video and keep referring to it, or you can just be coming and watching it on my YouTube channel so that you can continue learning. If you have watched this video up to this point, then arrogance is not one of your problems. Arrogant people rarely read or listen. They don't do that. They don't listen to experts. They think they are the center of the universe. They think they know everything. We don't know anything when we come to this market. We are just here to do what the market is doing and managing risk. That's what we are here to do. You know, these kinds of music makes your brain to be focused and productive. So that's the reason I decided to be having them on my videos, so that I bring you to the same level that I am, to make you understand what's happening at the moment, to have you think in probabilities. If this happens, then this happens. If this happens, then this happens. That's why I'm showing you these things. That's why I'm teaching you these things passionately, and I'm showing them to you in an orderly way, and the precision is just amazing. You cannot deny. This level of precision is just amazing. I'm also loving the level of precision. Don't ever stop doing this thing. If you have started, continue with that spirit, because this is where the world is headed. This is where the world is headed. The whole world. In Kenya, we have most people doing this thing. Very many people doing it, but very few are doing it the right way. I'm not saying that there are no successful financial market analysts in Kenya. They are there, but they will never show you something like this. Never. They will never tell you why they sold the market. They will never tell you why they bought the market. They will never tell you why they paid themselves. They will never tell you that. They will just be showing you screenshots of the money, big money, like millions of money. And let me tell you, this thing requires a consistent mindset. It requires a mindset that accepts failure and learns from it, slowly by slowly. Because let me tell you, you will also lose. Losing trades will come. You will lose, definitely. Let me tell you, you will lose. But what defines you as now a professional trader is that after losing, what steps do you do? What steps do you take to ensure the occurrence never happens, or you minimize on the occurrences? Because if you just have a refined risk management strategy like this one, that is measurable, you can know your progress. You can know where you are heading to. The roads might be bumpy, obstacles might be many, but if you have a system that you are following and you are refining, you are trying to perfect a skill now. You are trying to master the skill, and this comes with time. You'll have to work for it. It doesn't come easy. It's not easy. Even to me, it's not easy. It's very difficult, and you have to work out many things in your life. Just be patient and take notes and learn from what I'm presenting to you. Also go to your own charts and practice what I'm showing you here. Understand, it can be very difficult and frustrating to be doing the things I'm telling you here. There is nothing that comes easy in this world. Nothing. You are the one who is supposed to make the hardest things easy. And this is the most hardest thing you'll ever meet in your life. Just the same way, you cannot just go into a class of carpentry today and you expect that tomorrow you are now a good carpenter, making executive chairs and selling at 300,000 and above. That already suggests to you that even before you start, you fail. The same logic applies here in the marketplace. You must be very strategic. Don't just hop in and out as if you are playing brikicho games over here. You'll have to listen and take notes. Because this thing is like a development process. You'll develop from one step to the next, from one step to the next, slowly by slowly, yearly by yearly, monthly by monthly, weekly by weekly. You'll be going through a process, and you'll have to also take notes on how you are progressing. Maybe you are now new, you are a beginner, and you have just started listening to my videos and you have started learning. Just learn and practice for at least 3 months. You're just learning. The next 3 months, you now start taking trades on demo, and journaling them and learning from the mistakes. Also writing down the rules and regulations that will guide you through this. The next 3 months, you now start practicing with real money. Because you'll have gathered enough mental capital to help you psychologically when managing real money. You also continue facing hurdles, and you'll have to journal them and learn from them so that you can adapt all the seasons in the market and adapt to the market conditions that they do change seasonally. After 1 full year, you now advance to a level where you can successfully see the setups